The silver market has reached physical exhaustion. While the New York ticker quotes $93 per ounce, Shanghai has already breached $108. That is a $15 gap. The paper market is a mirage. Most believe silver is a simple commodity, a metal you buy when gold feels too expensive. The reality? Beijing just reclassified silver as a strategic critical mineral and triggered a total export ban, which means the global supply chain just fractured into two separate pricing systems. The proof is mathematical. On January 23, 2026, gold was trading at $4,956. Silver hit $93 in New York, but in Shanghai, $108. The arbitrage gap is now screaming that the Western exchanges are running a phantom inventory. Today, I'm breaking down the three mechanisms that prove the paper silver market is in cardiac arrest. Stage 1, the geopolitical put. Stage 2, the Shanghai vacuum. Stage 3, the credit freeze that just killed the wholesale market. A mandatory protocol before we open the file. This is not financial advice. I'm not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. Let me show you why war is the invisible hand pushing silver past $115 by February. The USS Abraham Lincoln Carrier Strike Group entered the Gulf of Oman in late January 2026. CVN-72, the USS Mobile Bay, a Ticonderoga-class cruiser, Destroyer Squadron 21. This is not a patrol. This is a forward deployment into a region that controls 30% of global oil transit. You see, war is the ultimate inflationary force, not because of the bullets, because of the monetary expansion required to finance the buildup. Every carrier group costs approximately $3 billion per year to operate. Every missile system, every forward base. The Treasury finances this through bond issuance. The Federal Reserve monetizes the debt. Your purchasing power gets diluted in real time, which means fiat currencies enter a debasement cycle the moment boots hit the ground. Plus, capital flows into assets with zero counterparty risk. Gold and silver are the only two monetary metals with a 5,000-year track record of surviving regime change. No credit risk, no bankruptcy clause, no terms of service that can be rewritten by a central bank at 2:32 a.m. on a Sunday. The data confirms the flight. Gold hit $4,956 on January 23rd. That is a 21% gain year to date. But silver, $93 in New York, a 48% gain. The gold to silver ratio just collapsed from 85 to 1 down to 53 to 1. The market is pricing in a supply shock. You see, the Gulf of Oman is not just an oil choke point. It is a psychological trigger. The Strait of Hormuz, the Bab el-Mandeb. These are the arterial routes that keep the global economy oxygenated. The moment a carrier strike group moves into position, insurance premiums spike, shipping costs double, inflation expectations reprice overnight, which means the silver market is no longer reacting to industrial demand or solar panel forecasts. It is reacting to the mathematical certainty that fiat currency purchasing power will collapse faster than the metal can be extracted from the ground. The vaults are already dry. COMEX registered inventories plummeted 26% in just 15 trading days. That is not a normal drawdown. That is a liquidation event. Western vaults are projected to be mathematically empty by mid-February. The timeline is no longer theoretical. Plus, the Shanghai premium is proof of panic. When Eastern buyers are paying $15 per ounce above the New York quote, they are signaling one thing. The paper price is fiction. They need physical metal, not a contract, not a certificate, the actual bars. If this geopolitical mechanism just clicked for you, or you want to track these silver market fractures as they happen, join the forensic circle by hitting subscribe. We hold ourselves to a different standard here. Let's move to the deep dive. But even this carrier deployment is a distraction from the real trap hidden in the exchange's fine print. The Shanghai arbitrage is not just a price gap, it is a vacuum cleaner. And the rule that is masking the collapse? Rule 589. The mechanism Wall Street is using to cap your exit while the vaults go to zero. The Shanghai arbitrage is not a trading opportunity. It is a vacuum cleaner sucking physical silver out of the West at a rate that guarantees the paper market collapses by March. Here is the mechanism. Eastern buyers are paying a $12 to $15 premium per ounce to bypass the New York exchange for physical settlement scams. $108 in Shanghai versus $93 in New York. That gap is not noise. It is a mathematical proof that the Western exchanges no longer have the metal to deliver. You see, the paper market operates on a fiction called exchange for physical, or EFP. The contract promises you can convert your paper claim into physical bars. But the fine print contains a clause. The exchange can settle your contract in cash if physical metal is unavailable, which means you never owned silver. You owned a bet on the price of silver. The Shanghai Gold Exchange does not offer that escape hatch. No cash settlement, no contract rollover. You buy 1 kilogram of silver, you get 1 kilogram of silver. Physical delivery is the default, not the exception. Which means the arbitrage gap is Eastern capital screaming one message. We do not trust your paper. We need the bars. Plus, the flow is one direction. Silver is leaving New York. It is leaving London. It is landing in Shanghai, and it is not coming back. The COMEX registered vaults dropped 26% in 15 trading days. That is 8.2 million ounces gone. The SGE vaults? Up 34% in the same window. The math is finished. The West is being drained. Let me show you the legal mechanism Wall Street is using to mask the panic. CME Rule 589. Dynamic price fluctuation limits. The rule was amended in 2022 to allow the exchange to impose 5-second trading halts whenever silver moves beyond a preset threshold. The stated purpose? To minimize market disruption and provide time for orderly price discovery. The actual purpose? To cap the velocity of the spike so retail investors do not realize the vaults are empty until it is too late. Here's how it works. The CME sets a daily price limit. Let's say silver is trading at $93. The exchange programs a limit of $7 per day. If silver tries to jump from 93 to 101 in a single session, the system triggers a halt. Trading freezes for 5 seconds. The algorithm recalibrates. The limit expands slightly. Trading resumes. But the halt is not random. It is timed to break momentum. You see, when a market is in a true panic, buyers are not thinking. They are reacting. The 5-second pause gives the algorithms time to inject sell orders and flatten the curve. The chart looks choppy. Retail sees volatility and assumes the rally is unstable. They sell into the halt, which means the exchange just stole your exit. The Shanghai Gold Exchange does not use dynamic limits. The price moves in real time based on physical bids. No halts, no circuit breakers, no algorithm smoothing the curve. If buyers are willing to pay $108, the ticker shows $108. That is the difference between a real market and a controlled market. One allows price discovery, the other allows price suppression. Plus, Rule 589 gives the CME legal cover to halt trading entirely if the move is deemed disorderly. The term disorderly is not defined in the rule, which means the exchange has discretionary power to freeze your position during the exact moment you need liquidity. The law is the trap, the system is in cardiac arrest, the proof is in the ratio. There are currently 16 paper claims for every single physical ounce of silver left in the COMEX registered vaults. Let me break that down. The COMEX holds approximately 47 million ounces of registered silver. Registered means available for delivery. But the open interest, the total number of contracts claiming that silver, is 752 million ounces, 47 million ounces of metal, 752 million ounces of claims. That is a 16-to-1 ratio. Which means if even 7% of contract holders demand a physical delivery, the system breaks. You see, the paper market was designed to operate on the assumption that most traders will settle in cash. They do not want the metal. They want the price exposure. The exchanges built the entire infrastructure on that assumption. But the assumption just failed. Eastern buyers want the bars. Institutional funds want the bars. The $100 billion AI infrastructure fund I am about to show you, they want the bars, which means the 7% threshold is no longer hypothetical. It is inevitable. Plus, the lease rates just spiked to 11%. That is the cost to borrow physical silver for 30 days. 11% annualized. The last time silver lease rates breached 10% was March of 2020, right before the metal ran from $14 to $30 in 8 weeks. Lease rates are the market's heart monitor. When they spike, it means physical metal is scarce. Traders are paying a premium just to access inventory for short-term delivery. The higher the rate, the tighter the supply. 11% is a cardiac event. Beijing just pulled the trigger on the export ban, January 2026. Silver was reclassified as a strategic critical mineral under the national security framework. The law is blunt. No exports of silver in raw, refined, or semi-processed form without explicit state council approval. The approval process? Undefined, which means it is a de facto ban. You see, China produces approximately 20% of global mined silver, 4,000 metric tons per year. That supply just disappeared from the international market. But the reclassification does more than cut supply. It signals intent. Beijing is stockpiling. The State Reserve Bureau does not publish silver holdings, but the SGE vault data shows a 34% increase in registered inventory over 15 days. They are not selling, they are accumulating, which means the global supply deficit just widened by 4,000 tons annually. Solar demand is already outstripping mine supply by 149 million ounces per year. Add the China export ban, the math no longer closes. Plus, the reclassification triggers a domino effect. If silver is a strategic mineral, then domestic Chinese manufacturers get priority allocation. Electric vehicle batteries, solar panels, semiconductor wafers. The industrial consumers inside China will absorb the 4,000 tons that used to flow to New York and London. Your supply just got cut. Their demand just got guaranteed. There is a $100 billion AI infrastructure fund draining physical silver off market to build a private strategic reserve. They are not buying futures, they are buying bars, 1,000-ounce London good delivery bars, direct from refineries, bypassing the exchanges entirely. The fund is structured as a sovereign wealth vehicle tied to national AI ambitions. The logic is simple. AI data centers require massive electrical infrastructure, solar farms, battery storage, grid redundancy. Every megawatt of capacity requires silver for conductivity and photovoltaic efficiency, which means this is not a speculative trade. This is a supply chain lockdown. They are pre-purchasing the metal required to build the infrastructure before the price makes the project uneconomical. The fund has already acquired an estimated 12 million ounces since December. That is 25% of the COMEX registered vault in 60 days. And they are not done. You see, when a whale buys off market, the price does not move. The transaction happens in the dark. No ticker update, no volume spike. But the metal leaves the available supply, which means the COMEX vaults are draining from a source the retail market cannot see. The arbitrage gap is the only visible proof. Shanghai is paying $108 because the whales already bought everything under $100 in the West. The floor just moved. The wholesalers are broke. Not bankrupt, not illiquid, broke. The high price just blew up their credit terms, and they can no longer finance inventory. Which means the secondary silver market, the junk silver market, the retail coins and sterling flatware market just froze. Here is the mechanism. Wholesalers operate on credit lines from regional banks. They buy bulk junk silver from estate sales, pawn shops, and retail sellers at spot minus 10 to 15%. They melt it, refine it, sell it to mints or industrial users at spot plus 5%. The margin is tight, but the volume makes it profitable. The credit line is collateralized by the inventory. The bank lends based on the spot price at the time of purchase. Let's say the wholesaler buys 1,000 ounces at $90. The bank lends $90,000. The inventory sits for 30 days while the refining process completes. The wholesaler sells at $95, pays back the $90,000, pockets $5,000. But what happens when the price moves from $90 to $108 in 15 days? The credit terms explode. The bank's collateral is now worth $108,000, but the loan was only $90,000. That sounds like a profit, except the wholesaler has not sold yet. The metal is still in the refining queue, and the bank just recalibrated the lending ratio. You see, banks lend based on volatility risk. When silver was stable at $25 for 3 years, they offered 80% loan to value. But when silver jumps 20% in 2 weeks, the bank drops the ratio to 50%. They are not stupid. They see the spike, they assume a crash is coming. Which means the wholesaler who borrowed $90,000 now has a credit line capped at $54,000. The bank calls the loan. The wholesaler has to post an additional $36,000 in cash or sell the inventory immediately. Most wholesalers do not have $36,000 in free cash. They are leveraged operators, so they sell into a rising market. At a loss relative to where the price is heading. Plus, the feedback loop just turned vicious. Wholesalers stop bidding on junk silver. Retail sellers call around. No bids. They assume silver is crashing. They panic sell to pawn shops at 30% below spot. The pawn shops are not refiners. They sit on the metal. The supply that used to flow into the refining pipeline just stopped. The vaults are not being restocked. The COMEX drawdown accelerates. The Shanghai premium widens. The credit freeze is the hidden artery that just got severed. Let me show you the historical rhyme. Spain, 1557. The global superpower. The empire, where the sun never set. The Habsburg dynasty controlled Europe, the New World, and the Manila Galleon trade route to Asia. They had the largest military in the world, the most advanced navy, the deepest silver mines in Peru and New Spain, and they went bankrupt. The cycle is identical. Stage 5, inflation. Spain debased the currency to finance the Italian wars and the Dutch revolt. They minted copper coins and called them silver. The market stopped accepting them. Inflation spiked. The cost of financing the military doubled every 3 years. Stage 6, the stop. The silver shipments from the New World were irregular. Pirates, storms, indigenous uprisings in the mines. The convoys that were supposed to deliver twice a year started arriving once a year, then once every 18 months. The treasury ran out of silver. The military was not paid. Mutinies broke out across the Spanish Netherlands. Creditors in Genoa and Augsburg refused to roll over the sovereign debt. On January 1st, 1557, King Philip II declared a suspension of payments, the first sovereign default of the modern era. You see, Spain did not collapse because they ran out of wealth. They collapsed because they overextended the military and became dependent on a resource they could not control. The silver remittances were the collateral for the debt. When the remittances stopped, the debt could not be refinanced. The math was finished. We are at stage 5 transitioning to stage 6. The pattern is not a metaphor. It is a mechanical sequence. Stage 1. Reserve currency status. The dollar became the global reserve in 1944 under Bretton Woods. Every central bank held dollars. Every commodity was priced in dollars. The U.S. could print money and export the inflation to the rest of the world. Stage 2. Financialization. The U.S. stopped producing goods and started producing debt. The trade deficit ballooned. Manufacturing moved to China. The economy became 80% services and financial engineering. Stage 3. Asset bubbles. The Fed dropped rates to zero after 2008. Quantitative easing inflated stocks, bonds, and real estate to all-time highs. Wealth concentrated in the top 10%. The bottom 50% owned 3% of total assets. Stage 4. Wealth gap and social fracture. By 2020, the Gini coefficient hit 0.48, higher than any period since the Great Depression. Political polarization spiked. Trust in institutions collapsed. The social contract frayed. Stage 5. Inflation. Pandemic stimulus injected $8 trillion into the economy. Supply chains broke. Energy costs doubled. The CPI hit 9% in 2022. The Fed hiked rates to 5.5%. The bond market crashed. 30-year treasuries lost 40% of their value. And now, stage 6, the stop. The carriers are in the Gulf of Oman. Military spending is expanding. The national debt is $36 trillion. The interest expense alone is $1.2 trillion per year. That is more than the defense budget. But here is the trap. The debt can only be refinanced if foreign creditors keep buying treasuries. China is not buying. They are selling. Japan is selling. The petrodollar recycling loop just broke. Saudi Arabia is now accepting yuan for oil sales, which means the Treasury has to rely on the Federal Reserve to buy the bonds. Money printing. Currency debasement. The exact mechanism that killed Spain in 1557. Plus, the silver supply shock is the modern equivalent of the irregular remittances from Peru. Solar demand is outstripping mine supply by 149 million ounces per year. That deficit has been running for 5 straight years. 745 million ounces of cumulative shortfall. AI infrastructure is accelerating the drain. Data centers require silver for electrical conductivity. Every megawatt of server capacity needs silver bus bars, photovoltaic arrays, and battery storage systems. The $100 billion fund I showed you in the last chapter, they are pre-buying the metal because they know the supply will not exist in 2028. The industrial users are competing with the monetary buyers. The vaults are being drained from both sides. Spain fell because they overextended the military and lost access to the silver that collateralized their debt. The U.S. is overextending the military and losing access to the treasury buyers that collateralize the debt. The carriers are in the Gulf. The deficit is accelerating. The vaults are dry. The Shanghai premium proves the West no longer controls the price. The cycle does not care about exceptionalism. The math does not care about the reserve currency. The pattern has repeated in Spain, Britain, and the Soviet Union. The variables change. The outcome does not. Stage 6 is sovereign bankruptcy triggered by military overstretch and a sudden stop in the resource or capital that props up the debt. We just hit the stop. The Shanghai arbitrage is proof. The vaults are empty. The credit freeze killed the wholesale restocking loop. The timeline is no longer theoretical. The math is finished. Most will ignore this data and pay the price. They will watch the New York ticker quote $93 and assume the spike is temporary. They will trust the FDIC insurance on their savings account and assume the system is stable. They will believe the official narrative that inflation is transitory and the Fed has everything under control. But if you are the type of person who refuses to be a victim of the script, join the forensic circle by hitting subscribe. We move into the deep dive on the 2026 debt wall in the next autopsy, the maturity schedule that guarantees a refinancing crisis by March. The credit default swaps that are already pricing in a sovereign event. The mechanism Wall Street is using to transfer your wealth before you realize the trap was sprung. The data is already written. We are just reading the next page. The carriers are in the Gulf of Oman. The vaults are dry. COMEX registered inventories dropped 26% in 15 days. The Shanghai magnet is pulling the price to $115 by Tuesday. The arbitrage gap proves the paper market is fiction. Rule 589 is capping your exit. 16 paper claims are fighting over every physical ounce. The lease rates hit 11%. The credit freeze killed the wholesale restocking loop. Beijing triggered the export ban. The $100 billion fund is draining supply off market. The math is no longer theoretical. The timeline is no longer flexible. The dollar has lost 99% of its purchasing power since 1913. The remaining 1% is being erased in real time. The carriers, the vaults, the Shanghai premium. These are not predictions. These are confirmations. The cycle has repeated in Spain, Britain, and the Soviet Union. The variables change, the outcome does not. Stage 6 is here. The math is now finished.